get into it a little bit. First, there's some legal stuff we got to get out of the way. You know how that goes. I am a commodity trading advisor. I will show you some trades that I have taken. I will show you some trades that I have not taken. And I'll make that distinction when we show them to you, but you need to understand that a lot of the trades, since I do all my work with automated trading systems, a lot of these trades you'll see have been created from historical data with the obvious 2020 hindsight advantage. And realize that some of these have been taken, some of them have not been taken, just so you understand that, and we will make that obvious when you see this. But it is a requirement from the Commodity Futures Trading Association administration that I do tell you this kind of stuff. Material presented in this online webinar is protected by the United States and international copyright and intellectual property laws. And that doesn't mean anything for most of you. You are free and absolutely encouraged to use any of this information for your own personal use any way you want. However, redistribution of this material to others is prohibited. Now, we don't care if you share this with some of these ideas with your fellow traders. The thing we kind of like to discourage is we don't really think it's a good idea if you take this stuff and try to sell it to somebody. So, and there's nobody out there that would do that, I'm sure. So anyway, that's all of that stuff. And consider that when I do all of my trading with automated self-adaptive trading systems, I do it all through the TradeStation and or multi-charts platforms, and it's strictly analytically based, it's strictly computer generated trades. But you have to understand that when we are using trading with technical analysis, we're effectively attempting to mathematically predict human behavior. If you think about this a little bit, every price change, every trade that you see on your screen, I don't care what it is the result of human behavior and of some nature. Either you pick up the phone, call a broker, you click a mouse on the screen, you get a tip from your barber and you call your broker, you program a computer, you're on the floor trading, whatever. This is all human behavior, and because of that, it is not a specific finite event. We're taking a subjective behavior, human behavior, and trying to analyze it objectively by programming technical trading signals. And you realize that's not easy to do. Now, we're trying to mathematically predict human behavior. That is a very difficult process. I have a nephew who's a psychiatrist. He's told me that if you ever get this figured out, let me know. We'll write a book and we'll spend the rest of the year and the rest of our lives in Hawaii. It's pretty not possible. So when you get that, with that in mind, when you're doing programming, when you get results from automated trading, and you approach that 70, 75, perhaps 80% profitable level, you're about there. You're not going to be able to get the last 20% because we're not yet able to program anything to do what the human brain can do. I listened to Elon Musk on a podcast a while back in the car, and he's made some remarkable remarks about what could be coming up with artificial intelligence and how computers will eventually have the command of most of the intelligence on the planet, which is kind of interesting, but we'll let that one happen when it happens. But right now, if we get to 70% on the trading percentage profitable, you better quit there, because you get any beyond that, you're curve fitting, and that doesn't work. We'll get into that a little bit later. Remember that technical analysis is not a world of absolute certainty, but a world of probabilities and possibilities. Everything we do here is based on the probability of a certain chart pattern repeating itself at some certain level. And all the technical analysis stuff is just purely technical, purely mathematical, purely probability, and certainly not anything definite. It's just another way to trade. I'm the world's worst discretionary trader, as are most doctors, lawyers, surgeons, airplane pilots, and so on. They have to have everything exactly perfect before they do their thing. If they try to trade that way, it's not going to work for them. They have to wait for everything to be 100% perfect before they pull the trigger. And that's fine, because you don't want your airplane pilot hitting 80% of his landings. You don't want your cardiac surgeon being 50% successful. Those types are not the good traders, and that's where I find myself That's why I do everything with an automated system, because I spend too much time trying to analyze stuff, but if I let the computer do it for me, I get along fine. That's where I get my giggles out of seeing the computer do it the right way. So I do most everything with automated systems. And within automated systems, we have exits like anything else. We have entries, we have exits. All my systems, the main ones I use, have one entry parameter, one entry signal. They can have up to 7 different exits. You don't make your money until you exit the trade. Entries are easy. Knowing when to get out and not give up too much of your profit is a big deal. Now, practical trailing stops are a part of that. Principal use of a trailing stop is to protect profits. I have had so many trades before I put these new adaptive trailing stops in. So many trades go up for a good profit and give it all back, and then some go into a loss when you had a decent profit and you try to get more and try to get more, and all of a sudden the thing falls apart and you've lost 80, 90, or 100% of your trades. I've been able to establish a use of self-adaptive trailing stops into my systems, which has been working very nicely. I'll show you how well before too long. Had a good day yesterday. I'm going to show you all the trades I did yesterday in my real live account, so you can see that I really do use these things. People always ask you, do you really trade your stuff? Yeah, I do. Do you market your stuff? Yes, I do. But I trade at my own account before I do that. And this is what you're going to see a little bit of today, is how I'm using some of this self-adaptive trading, using trailing stops. Ideally, trailing stops allow a trade to continue to generate profits while limiting the amount of achieved profits that can be lost should the trend reverse. In other words, if your profit's going up, you made $10, but you made 50, you made 100, you made 200. A trailing stop would get you out. Let's say you got your 200 and you had a 50% trailing stop. It would get you out when the profit level drops 50% down to $100. If it goes to $300, it's going to get you out at 150. It goes to $400, it's going to get you out at 300. It's just a matter of keeping a logical trailing stop that will protect your profits. Downside is that it will not let you catch that big trade, but will also not let you catch that big loss, and that is the big deal. If you protect your system, protect your profits, and limit your losses, you're going to be a lot more successful than those that don't. By this definition, a trailing stop will set a stop exit position based on a specific dollar amount that trails the greatest position profit. Now that should read a specific dollar or point amount. You can do it either way you want. The one I'm working right now does points, but that's a simple math conversion if you want to look at it that way. A stop order is generated and put in the trade as an automated system exit at the calculated price based on the actual trailing amount. Amount is the greatest open position profit that you're willing to give back. You are willing to give back a certain percentage or a certain dollar amount. That's where you set your trailing stop to actually engage and kick itself in. So it's just a slick way of protecting your profits. Problem is that most trailing stops incorporated in many of the trading platforms. I don't care if it's TradeStation, Thinkorswim, Multicharts, any of these. They tend to exit the positions too early in the trade. They're not adaptive enough to know if a trade's actually in progress, how long has it been in progress, what is the average amount of profit for this particular type of trade, where is your threshold for kicking in your trailing stop, and how big does your trailing stop have to be. Now my adaptive stops I'm going to show you here a little later will actually determine by themselves the range that you can look at to establish a maximum potential profit for any given trade. It's based on a lot of factors. And it will also look at historically how much of a pullback you can tolerate and still get the maximum amount out of the trade. You're never going to get everything out of that trade that you think you could have. It just doesn't happen. This is just a way to enforce the discipline to get a practical amount of money out of each trade. And like I say here, a lot of these canned stops in these platforms don't get that done. Now let's look here at And this is a trade that I put together from a trade that happened a few weeks ago. It's in the E-mini S&P futures. It's going to be all the trades here are going to be from the E-mini S&P. We might show a few NASDAQs if we have time, but most of this is going to be in E-mini S&P. Now you can see here that we got a long entry, a little blue arrow pointing up, a long entry. We get up here quite a while later, we have a reversal. And then we get out here in a close time. This is a perfect trade. But there's some places along the way here where trailing stops could have really taken you out way too early. Now the first one we want to look at is what they call a parabolic stop and reverse trailing indicator. You can also turn this into an automated trailing stop if you like. Here's what it looks like. Here's our same chart with the entry point down here. And these little blue dots that you see trailing up along underneath the price bars is your actually trailing stop. And when you get up here, when you see the last little blue dot and then the pink dots start to happen, you would have been taken out at the point which the price bars cross that little blue dot. And that's going to take you out of the trade. But you could have had enough profit way over. You see where the reversal is up here. You missed all of that by getting out of the trade somewhat too early. Now here's a graphic example of what happened to us. Here's the parabolic trailing stop, the little blue dots. We're stopped out by the trailer at the point designated here by the red arrow. But here's what happened to us. We lost profits of all of this amount that could have taken place had we gone all the way up to the reversal. So there's what you left on the table. And here's a perfect example of the can trailing stops in your, this happens to be in TradeStation. It's a parabolic, is one of the oldest ones ever written about by Wells Wilder way back in the 70s. It's the first book I ever read on trading, but it's still a good one. But the stuff they give away on the platforms, if it's going to be that good, why are they giving it away? You ever think of that? Well, here's a profit you could have lost here by using the can trailing stop. Now let's look again at a different kind of trailing stop. You notice that, we go back to this other one briefly, you notice that the dots on this trailer never back up. They always work in closer and closer to the actual price bars until they're triggered. Now, if we look at the next one, this is the volatility trailing stop that I programmed some years ago. And you'll notice that as the volatility increases, and volatility being described easily as the size of these bars, if you want to be that brief about it, as volatility increases, you'll note that this trailing stop, on this trailing adaptive stop, will actually back up and give you some more room. You see up here where the price bars started rolling over, instead of becoming closer to the bar, this thing adapts itself and is now coming back to get triggered at a later point. Problem is, we still got the same stop out going on here. We still got stopped out about the same point. So just adapting the stop by volatility isn't quite going to cut it. Now on this same chart, note that this indicator starts independent of the trade. It starts way back here and is in progress. It's already crowding the market before the trade starts. And that's why we get stopped out up here. Because if we started way too soon, we're not taking into account the profit on the trade. We're just looking at the price bars and responding accordingly. Now, if we take this same adaptive stop, the same volatility stop, and coordinate this with the actual trade, you can see we have the same. This is the exact same program stop that we had before. The only difference is that we coordinated this to start with the trade, which you got to admit is kind of a logical thing to do, because we don't want to run a trailing stop until we've got a trade. We don't want the trailing stop calculating and utilizing any data that occurred prior to the trade. We wanted to look at data that occurred when our actual trade was in progress. We're just looking at the long trade up here. If you look at the short trade, you see the same thing. We did hit the close time before this self-adaptive stop could get into it. But you'll see that the dots went from blue to red exactly the same time as the trade went from long trade to short trade. So this is the stop that adapts itself by starting only when the actual live trade is initiated. Notice here that where the indicator is initiated by an actual trade, the trailer is not taken out by the increased volatility, but still protects their profits. You remember on the previous slide, right in the same area where you see this red arrow, the adaptive stop stopped us out. But when we coordinated this with the trade, the exact same calculations work because we're only using it when an actual trade is in progress. Now, just to get an idea of what we're doing here, we started with the canned parabolic trailing stop, and that one didn't work so well. We changed that to a volatility-based self-adaptive trailer, and that worked a little better. But when we coordinated that with a volatility-based stop for the trade generation, then we had something that worked quite a bit better. Now, the next step will be to add the ability to place an adaptive stop based on the average size of each trade and the average pullback for each trade, for each selected symbol, and the average effective trailer for each trade. In other words, we're going to let the computer decide what is the amount of trade we want to get into before we initiate the stop, and how far do we want to let this thing pull back before we take our profit, all based on historical trades that have happened for quite a while back on this particular item. And in a sense, this is artificial intelligence. This is letting the system and letting the computer program learn what has worked well in the past and adapt it as time goes forward. And this is a coming thing in self-adaptive system trading. We are using a lot of artificial intelligence. I've been doing this I've been using this AI thing. They didn't call it AI, they called it neural networks back in the late 90s when I first started screwing around with this stuff. But it's the only way I've really been able to make a system stay in sync with the current market. And these self-adaptive trades are trailing stops are a big part of that. Now, if we look at this, happens to be the trading pattern that happened yesterday, Monday, January 7th. We had a number of trades come in here. Now, these are the self-adaptive trends and trails that are set up by the computer itself. Look down here on the lower right, about 8:30, we had a long trade. We got stopped out at the trend trail. Right, we could have had a lot more profit coming up here, but you know what? If you hadn't had that trailer in there, we would have been stopped out at this first pullback. Instead of making, I think we made 250 bucks on that, we would have lost about 600 had we gotten stopped out there if that trend trail hadn't kicked us out. Same way with trade number 2, a little less profit. I think this one actually had the same amount of profit. Same idea. We got out of here and the computer started getting scared. Hey, this thing's going to pull back and we're going to get clipped. Let's just get out. Next trade comes along, we make a lot more money. We got in here with the thing ran up. The computer analyzed this. So, okay, we're going to let this run a little longer. Gets up here, got a little scared, we jumped out. Same way on trade number 1, 2, 3, 4. Trend trail, same thing. Trade number 5, trend trail, hit the same thing. And we got up here on the last long trade, we got stopped out. That is an indication that we're over with that trend. We're going to start looking at the other side. And the computer then switches over and looks at the short trades that have happened on this item historically, and we'll begin to make its calculations as such. We get into one short trade, again, take the trend trail. This one wasn't going anywhere very fast, and as soon as we started slipping out of this range, computer says, that's enough, let's get out. Last trade of the day, we did have a stop loss, unfortunately. No, but that happens. Now, let's take a little closer look at the first 3. Let's go back to this. Notice the first 3 trades that happen on this chart. I'm going to break out just those 3 trades and look at them in a little more detail. Here was our first one. We got trailed out where the little white arrow is. The second one we got same thing. The third one made a lot more money. And here's what they actually made. The first trend trail exit wound up being a plus 250. This is on a 2 lot of the ES E-mini futures. Second trade also made $250. That's kind of the standard. But on the third trade, that self-adaptive stop didn't stop us out just willy-nilly on some little dot floating around here. It figured out historically using AI that this thing is actually got more potential, and made $675 on the third trade. And these are all pretty fresh, but these are all trades I took yesterday. Now, these are the actual trades that we took on Yeah, January 7th, yesterday. And it's the same chart I showed you before. I just labeled this to reinforce, to reemphasize that these are actual trades. Now, here's what we've done just this month. We started this analysis on January 2nd. You see what the net profit was each day, and these are real trades. And we took 7 trades, 10 days, trades, 8. Now, last Friday wasn't that great of a day, but we still were up a little bit on 8 trades. 8 trades yesterday. You can see we did a little over 2 grand. Did a little over 2 grand on most of these. That is just the periodic returns, and these are generated by TradeStation, so it's pretty accurate. There's the equity curve we did using this system on actually the first, well, it's actually the 2nd of January up through the 7th. The 1st is the first day, but there's no data there. There's the net profit for the same time period, January 1st through January 7th. And if you want to go back, people always ask me, I think it's kind of superfluous because we don't really look, I really don't care what happened a year ago, but a lot of people want to see what did your system do over the last year. There's what it did over the last year. And is that a guarantee it's going to happen that way again? No. It's an indication that the probabilities are on your side when you're using an automated system and have a logical approach, which is reinforced by the computer doing the trading for you. Nice thing about an automated system is that it does the same thing, same way every time. The wrong thing with a fixed variable system is that they do the same thing every way, every time. Same idea. The self-adaptive systems tend to change their bearings, change their parameters, their active parameters, as time goes by, and that's why I call my systems to be self-optimizing systems. Now, you can get free computer code for the trailing stop, the self-adaptive trailing stop. It'll go into TradeStation, it'll go into multi-charts. It's open code, so if you want to take it and program it into another system, whether it be Thinkorswim, NinjaTrader, Sierra Charts, you name it. They're all different programming languages. I am a quadriplegic when it comes to other stuff like that. I've never had a computer trading course I've never had a computer programming course in my life. I've managed to learn easy language in TradeStation by hitting this and poke here and squeeze there, but it's not the way you do it, but that's the way I wound up doing it. But you can, that's why I'm giving you the open code. Anyone that's done any programming will be able to read the code on this thing and understand how to program it into another system. There's my email address, jclayburg@iowatelecom.net. If you would care to send me an email at that email address, request the code and the self-adaptive program. This is actually a strategy that you can put below any strategy in your TradeStation and or multi-charts that will actually put these trailing stops in on a self-adaptive basis on any system, anything you want to put, any item at all. It'll figure out what's going on and do that for you. Now, this is the first iteration. I've got some upgrades coming along that you will receive probably an upgrade or two on this over the next few days, maybe a week. I got some things in mind I want to do changing that. So what you're going to get, if you send me an email and request this program, you're going to get the current version, and you can expect updates for a little while. And as I've got some other ideas that might be able to tighten this thing up a little bit. I've got them programmed right now, but I haven't got. I just worked on some stuff today. I haven't really got them tested yet, and I don't send anything out like it's actually till I have a chance to trade it in my own account. But if you would like to have a crack at this, or when you want to give it to your program, I don't care where you use it. It's been a lot of work going into this, but life's been good to me. Trading's been good to me. A lot of people have been good to me. I'm getting toward the end of my career. I'm 72 years old. Lord knows how long I'm going to do that. I don't mind giving something back to the trading community. So if you guys want to take this, do anything you want with it, give it to your programmer, use it yourself, program it in to your own system, however you want to do it. All you got to do is send me an email. I'll send you the thing. And this is a one-horse operation. I don't have time to talk to everybody, but if you guys want to shoot me an email with any issues or anything you see, maybe we can address that or get back to you in a later edition. I always tell my first career was as a veterinarian, and I always tell people that I'm the only guy here, and you're talking to this is a one-horse operation. You're talking to the horse. And then I always tell them that at the end of the conversation, it's up to you to decide which end of the horse you've been talking to. And if you haven't been on a farm, you probably still figure that one out.